In today's video, we'll be talking about the ideal order of investing. When I started making more money than I needed to live comfortably, I wonder how I should invest that spare cash. Should it be stocks or real estate first? Turns out it's neither of those. According to a survey by Bankrate, 56% of US adults wouldn't be able to pay for an emergency expense of $1,000 or more. So, the first thing you should do with your money is set aside an emergency fund. Think about it as a pot of cash, especially for emergencies. While I was in university, a family member needed some help with an unexpected medical expenses. At that moment, I was fortunate enough to tap into my emergency fund to help out. Had I not set aside that money, we would probably have had to borrow and take on debt, which, for reasons I'll talk about later, isn't ideal. Ideally, you want to have between 3 to 6 months worth of living expense saved up. So some of what we spend each month on rent, food, transport, utilities, healthcare, household items, and so on. Then multiply that figure by at least 3. The psychological benefits of having an emergency fund are enormous. Even though putting away this pot of money isn't an investment in the sense of yielding real returns, this psychological security is the foundation for building more wealth.
When you're 20, even when you're 30, and in my belief, whatever age you are, I believe that you should take all of the excess money, live as cheap as you can, take 100% of that excess money, and invest it in education that increases your earning capacity.
This quote from entrepreneur and investor Alex Hormozi leads us to the second thing you should do with your money. After setting aside an emergency fund, you should invest in your education and skills. The sad truth is that most of us think of education as something that happened in classroom. But if you truly want to build wealth and you acquire money-making skills, you need to shift your mindset from classroom learning to lifelong learning. In a 2022 survey on adult learning, some researchers in the UK found that only 1 in 5 adults said that they're currently learning, and almost 1 in 3 said that they haven't learned since they left school or university. The bottom line is that being a lifelong learner is a trait that sets you apart from 90% of the population. Although I'm glad I followed conventional advice and did an engineering degree in university, I'm actually proudest of the moments when I took learnings into my own hands. This means learning outside of the traditional classroom. For example, since I started learning about trading and investing, I have spent over 6 figures on courses, tuition, and coaching for both myself and my team. Yes, it's a lot, but to me, there's no better investment. That kind of investment is what allows me to make more and more money today, and what allows me and my team to become the best teachers and coaches to our students. So treat each skill as a stock and invest in it wisely. Whatever you are trying to do, don't forget that skills stack on top of one another to make you a more valuable asset. Each skill built on the former one in the same way that investments compound over time. The majority of the household hold the bulk of their wealth in real estate. Although I spend most of my days thinking about trading as an investment vehicle, there's no denying that the real estate I own contribute to the bulk of my asset. This leads me to the third thing you should invest in after your skills and education: real estate. There are at least 3 reasons why investing in real estate comes so high in my ideal order of investing list. First, appreciation. Historically, house prices tend to appreciate, whereas you don't get anything back from renting. If you buy a property for $500,000 and it appreciates to $550,000, you'll probably make you a 10% return. In reality, most people in the US don't buy the house outright. They put down a 20% down payment. This means that the leverage return from house appreciation is even higher. If you put down 20% of $500,000, that's $100,000. And if this property appreciates by $50,000, that's a 50% return. Second, security. One of the biggest benefits of buying a house is that you're putting down your roots somewhere. You get this feeling of security and stability because you know that you have a roof over your head and there's no landlord and you know it's your proper home. Third, commitment. Buying real estate is what economists like to call a saving commitment device. If you take out a mortgage to buy your home, so if you think you are the kind of person who will struggle with committing to saving a certain amount per year to build up your net wealth, then buying a home could be a reasonable forced saving device that makes you keep your spending in check. The average American has $90,000 in debt, and we have somehow accepted this as normal. I've personally been very fortunate to not have to stack up high interest debt. My parents and my Asian upbringing has instilled in me the value of saving up and spending within my means.
People love to brag about how much money they spend. Asian people, on the other hand, we do the exact opposite. We love to brag about how little money we spent on some shit. Because the art is in the savings. You never pay full price. Like my mom, her catchphrase is guess how much.
Jokes aside, the problem with the high interest debt is that there is an opportunity cost. That is, by having a debt, you can't do other things with the money you need to pay off that debt. And that's not even mentioning the psychological burden of the debt. This leads me to the fourth thing you should invest in after real estate. Get rid of your high interest debt. Any type of borrowing with an interest rate above 8% is considered bad debt. The reason for this is that historically the stock market returned 8%. So one obvious opportunity cost of debt higher than 8% is the money you could be making by investing in the stock market instead. So write down every debt you have and write down the interest rate on that debt. Rank those debts in the order of highest to lowest interest rate. Then begin to pay off any debt that is above 8%. By this point, you have an emergency account. You have invested in your skills. You have potentially paid a down payment for your real estate, and you have sorted out your high interest debt. The next thing to do is investing in individual companies or index funds. The easiest ways to do this is through an investment account with tax advantages. In the US, this account is called a Roth IRA. In Canada, it's called a TFSA. If you buy stocks and shares through these accounts, you get two tax benefits. First, you get tax-free growth. If you get dividends or if you sell those stocks, you don't pay tax on the capital gains. Second, you also don't pay tax on it when you withdrew from your account. Sounds great, right? Well, there are some downsides. First, there's a limit on how much you can invest. In the US, you can contribute up to $7,000 if you're under 50 and up to $8,000 if you're over 50. Second, you can't contribute if you have too much money. In the US, you can't contribute if you're single and you make more than $161,000, or if you're married and your combined income is over $240,000. Many of you might fall into this high income bracket. High income earners turn to something called a backdoor Roth IRA. This strategy can get a little complex, so we're not going into the detail. Whether it's a Roth IRA or backdoor Roth IRA, the conventional advice is to invest in boring stocks. This usually means investing in an index fund like the S&P 500 rather than individual companies. This is a fantastic advice if what you care about is building wealth for the long term. It's really hard to beat the stock market, so you can't go far wrong by investing in the S&P 500 and let the compound interest do its thing. Personally, on top of this long-term investment strategy, I also want to generate a higher than average return of the S&P 500 in the short and medium term horizon. The way I do this is by trading options against S&P 500. This kind of investment and trading are mostly done outside, but can also be done in these tax advantage accounts if you have the right guidelines. There's a way to get more money from your employer without asking for a raise or a promotion. The trick is to take advantage of something specific in your retirement savings plan, the pot of money you're saving up for retirement. In the US, this is commonly called the 401k. In Canada, is commonly called a group RRSPs. This leads us to the sixth thing you should do, which is taking advantage of a specific part of a retirement plan called employer-employee match contribution. When you contribute a certain amount to your retirement pot, your employer matches your contributions too. They essentially give you free money for your future retirement. The most common matching formula is a 100% match for the first 3% and 50% match for the next 2%. Let's say you make $100,000 per year. If you make the full contribution, you will contribute 5% of $100,000, and that's $5,000 into your retirement pot. In turn, your employer would put $3,000 plus 50% of the $2,000, and that's equal to $4,000. So you have added $9,000 into your retirement pot by the end of the year. Given that you have only paid $5,000, that's a return of 80%. That sort of annualized return is pretty hard to come by. Okay, you might be wondering, Cody, why would I invest in a retirement plan that I can only withdraw from when I'm in my late 50s or 60s? Good question. My honest opinion is that even if you're on the right track to retire early, which I hope you are, maxing out your retirement plan gives you an additional source of income in your later years. And investing in it today while you're young yields incredible returns, as we have just seen. On top of that, investing in these retirement funds comes with two tax advantages. First, all contributions are made on a pre-tax income. So if you contribute to your retirement savings plan, you pay less income tax. In 2024, the most you can contribute to a 401k is $23,000. So if you make $100,000 per year and you max out your 401k contribution, your taxable income isn't $100,000, but $77,000. Second, you don't need to pay any taxes on the gain from your retirement plan until you withdraw it. That's it. The tax is deferred. Reason there's been quite a bit of buzz about the overlooked retirement savings vehicle or an overlooked wealth builder. It gives you a rare triple tax break, but most people have no idea that you can use this as an investment. It's called a health savings account. What makes an HSA special is its triple tax benefits. First, you get a tax benefit when you put money in. Second, you don't get taxed on the returns you make on that account. So you can invest that money and enjoy tax-free growth potential. Third, you can withdraw from your HSA to pay for qualified health expenses, and you don't need to pay any tax for withdrawing. According to Fidelity, an average retired couple age 65 may need around $315,000 in after-tax savings to cover healthcare expenses and retirement. So the HSA becomes super valuable when you're older and need more medical care. There's some nitty-gritty rules to bear in mind when it comes to the HSA. First, eligibility. In Canada, all employees are eligible. In the US, only people who sign up for a high deductible healthcare plans are eligible. This is a type of health insurance that features a high deductible. This means you pay a lower monthly premium. Second, the amount you can contribute. In the US, you can contribute $4,150 if you're an individual and $8,300 if you're a family. And given the triple tax benefits, it would be wise to max this out. In Canada, there's no upper limit to that amount you can contribute. So there you have it, the optimal order of investing to build wealth for the long term. But before you start implementing this ideal order of investing, you might be wondering how to earn that excess cash for investing. If that's the case, I've got just the perfect video for you.